All right, everybody, welcome back to the show. Today we are diving into the world of junk bonds.
That's right.
And before we get started, I do want to say that this is for informational purposes only.
Absolutely.
Not investment advice.
None at all.
We're not telling you to buy or sell anything.
Nope.
We're just here to learn about junk bonds.
That's it.
So junk bonds are high-yield corporate bonds that are rated below investment grade.
Right.
And so that means they're considered to be riskier than investment-grade bonds.
Definitely riskier.
But they also have the potential to offer higher returns.
Absolutely.
So that's why they're called junk bonds.
They're a bit of a gamble.
Exactly.
Like a gamble that can pay off.
Right. And so we're going to try to understand, what are the pros and cons of junk bonds?
I think that's a good place to start.
And we're going to be looking at this specifically through the lens of ETFs today.
Sounds good.
So a few popular junk bond ETFs that our sources pointed out
Okay.
were the iShares iBox High Yield Corporate Bond ETF.
Yep.
That's HYG. The Wisdom Tree U.S. High Yield Corporate Bond Fund.
Mm-hmm.
That's QHY.
Mm-hmm.
And
Let's see.
the X-Trackers USD High Yield Corporate Bond UCI's ETF,
Oh, yeah.
which had a pretty long name.
A mouthful.
But those are just a few examples.
Of course. Yeah. There are a lot more out there.
Exactly. And at the time of this recording, these ETFs were offering yields of 7.5%, 6.67%,
Wow.
and 7.67% respectively.
Whiskey juicy.
Right. So, I mean, you see these yields and you're like, wow.
Yeah. Sign me up.
Right. But what are the risks?
Exactly. There's no free lunch.
So what are the risks?
Okay. So our sources highlight 4 key risks associated with junk bonds.
All right, let's hear them.
First up, we have default risk.
Default risk.
Yeah, this is the big one.
Okay.
Basically, since junk bonds are issued by companies with lower credit ratings, there's a higher chance they might not be able to repay their debts.
Makes sense.
So for investors, that means you could potentially lose your money if the company goes belly up. It's like lending money to that friend who always forgets to pay you back.
I have a few of those.
We all do.
Okay, so default risk is one.
That's number 1.
What's next?
All right, next we have interest rate risk.
Oh, yeah. Interest rates have been all over the place lately.
Tell me about it.
So how does that affect junk bonds?
Okay, so imagine you buy a bond with a 5% yield.
Yeah.
Then interest rates rise and suddenly new bonds are offering 6%.
So my bond looks kind of lame now.
Exactly. Your bond is less appealing because you could get a better return elsewhere.
Gotcha.
This applies to all bonds, but junk bonds can be particularly sensitive because they tend to have wider credit spreads.
Now, hold on a minute.
Uh-oh.
You just said junk bonds can be sensitive to interest rates?
Right?
But I thought I read that junk bonds are actually sensitive to interest rate changes than those safer bonds.
You're right.
So what's the deal?
Oh, it's all relative.
Okay.
Junk bonds are less sensitive to broad interest rate movements because their yields already price in a higher level of risk.
So they're already kind of expecting things to be volatile.
Exactly. They're playing in a different league with different rules.
Okay, that makes more sense.
But that doesn't mean they're completely immune to interest rate risk.
Right.
For example, a sudden spike in interest rates could still cause junk bond prices to drop.
So it's like they're less sensitive, but not totally immune.
That's a good way to put it.
All right, what's the next risk on our list?
All right, so the third risk is economic risk.
Economic risk.
Yeah, basically when the economy takes a downturn, investors tend to get scared and move their money into safer assets.
Like gold?
Yeah, or government bonds.
Okay.
So this can lead to a decrease in demand for junk bonds, which can drive their prices down.
Even if the underlying companies are doing okay.
Yep. It's all about market sentiment and perception of risk.
So it's like a domino effect.
Kind of.
The economy sneezes and junk bonds catch cold.
Yeah, something like that.
All right, and what's the last risk?
The last one is liquidity risk.
Liquidity risk.
Yes, and this refers to the risk that you might not be able to sell your junk bond quickly or easily when you need to.
Oh, so it's like trying to sell a house in a bad market.
Exactly.
Nobody wants to buy.
Right, and if you need to sell quickly, you might have to accept a lower price than you want.
So it's like being stuck with a car that you can't get rid of?
Yeah, it can be a pain.
Okay, so we've got default risk, interest rate risk, economic risk, and liquidity risk.
Those are the big 4.
Those are the big 4 risks of junk bonds.
Yep.
All right, now, our sources did mention something called interest rate hedged bond ETFs
Oh, yeah, those are interesting.
as a way to maybe mitigate some of these risks.
Potentially, yeah.
So tell me about those.
So imagine you could invest in junk bonds, but without having to worry so much about interest rate risk.
That sounds pretty good.
That's the idea behind interest rate hedged bond ETFs.
So how do they work?
Well, they use various strategies like shorting treasury futures to offset the impact of interest rate changes on their portfolios.
So it's like they're hedging their bets?
Exactly.
So if interest rates go up, these ETFs are less likely to be affected.
That's the goal.
And that means their yields can stay more stable.
Right. And that can be very attractive to investors who are looking for income.
Especially in a rising interest rate environment.
Absolutely.
So it sounds like these interest rate hedged bond ETFs could be a good option for investors who want exposure to junk bonds, but don't want to take on as much risk.
Yeah, they can be a useful tool.
But of course, there are always trade-offs.
Of course.
For example, the hedging strategies can sometimes limit potential gains if interest rates fall.
That's true.
And you're still exposed to the other risks of junk bonds, like default risk, economic risk, and liquidity risk.
Right. No investment is perfect.
Exactly.
You always have to weigh the risks and rewards.
All right, so to sum it up, junk bonds offer the potential for high returns, but they also come with significant risks.
That's a good summary.
Investors need to carefully consider these risks before investing in junk bonds.
Absolutely.
And as we said at the beginning, this deep dive was for informational purposes only, not investment advice.
Not at all.
So please do your own research and talk to a financial advisor before making any investment decisions.
Good advice.
So listeners, here's something to think about.
Okay.
Knowing the risks and potential rewards of junk bonds, would you consider adding them to your portfolio?
That's a good question.
And if so, how would you manage the risks?
Yeah, there are a lot of different strategies out there.
Let us know what you think.
We'd love to hear from you.
All right, that's all the time we have for today.
Thanks for listening.
Thanks for joining us.
It was fun.
We'll see you next time.
See ya.